Hi, Feroze. Thanks for joining in. It's Amina. It's been exciting. The last few weeks, the last few months have been exciting. But let's not forget that after many, many years, this is the first budget that a coalition government is going to be unveiling for us. From somebody who's tracked so many of these budgets historically, what do you think is the expectation today? What is a wish list from a market participant and from somebody who advises long-term investors?
Good afternoon, Samina. To my mind, like you rightly said, this is the first maiden budget of this coalition government. Of course, it's not like a pure play coalition government because the majority, of course, the 272 mark was not crossed, but I think it's still a powerful government. So I personally, from a capital market standpoint, have three expectations, not from a tax standpoint, but from an economy standpoint. The first expectation is the fiscal consolidation should continue. That's first expectation. The second expectation I have is the capital expenditure implementation of the 11 lakh odd crores, which is 11% growth. That should happen efficiently. That's the second expectation. The third expectation is the last term, the disinvestment targets were not met. But this time around, I hope the disinvestment targets get met. 36,000 crores is what was the average disinvestment as against 65,000 crores, which was targeted. So these are the three broader expectations. But from a fiscal consolidation standpoint, if I dwell deep into it, I personally think that the fiscal deficit targets are being met, and actually, first time ever, not first time ever, but very few times have we kept our fiscal deficit numbers down by 1 lakh crores, which I think is brilliant. The tax collection on the GST side, the growth has slowed down, but the direct tax collection is expected to grow at 13%. So that should support fiscal consolidation. I personally think prudence with respect to fiscal deficit is very critical for the FIIs to see this economy as a far more positive economy over the next 10, 15 years. And that, I think, in this term has to get more and more established and reinforced for foreign investors to become more sticky, unlike the last few months.
Right. Feroze, I'll spend some time talking about capital expenditure because I think that's going to be very critical for the markets. But just before I go into that, there was that bumper dividend payout by the RBI. How do you feel this money is going to be used and spent? Is it going to have a significant impact on reduction in market borrowings, you think? And hence, that then has a follow-on effect on the debt market and then equities as well.
Sabina, in my opinion, of course, the dividend has been 2.1 lakh crore as against 0.9 lakh crore just the previous year. Of course, it's a lakh and 20,000 crore more of dividend. And I think the PSU banks' dividends have also been very good and they are expected to be good. But I don't see this as one of the tool or one of the lever which can bring down borrowing of the government. I think the borrowing, net borrowing of 11 odd lakh crores will happen because the expenditure is going to grow and the budget size is going to be almost about 47.66 lakh crores, growing by about 7.3% vis-a-vis the 44.4 lakh crore, which is the provisional number so far for the last fiscal. So net what I'm saying is this extra dividend will be cushioning the expenditure increase of about 7.3% and the borrowing of 11.5 lakh crores, net borrowing, and the gross borrowing of 14.1 lakh crore may remain. But it's still the yields will be softened because of our inclusion in the bond index. $12 billion have come from September after globally. I think another $18 billion is expected. So I think the yields on the long end of the yield curve may not rise in spite of the borrowing remaining elevated, given the fact that RBI has given a larger dividend, but I don't expect net borrowing to come down, Samina. And I think it's a brilliant question, and that's what the debt market is looking at.
Feroze, the space that's been most excited ahead of the interim budget, ahead of the elections, and now, of course, the final main budget has been PSU stocks. And when I say PSU, specifically mean railway, defense, and fertilizer. It's been so tough to read what these stocks are getting up to. And of course, Chandan may have a better idea on the charts. But fundamentally, do you feel like the markets are getting ahead of themselves in terms of expectations? Or do you feel this budget is going to be all about growth, development, and sectors like defense, railway, and fertilizers?
Yes, I think they have definitely from a valuation standpoint, and if you look at that as the dimension, of course they've gone ahead in terms of what valuations you would want to give these companies and these sectors, definitely ahead of time and ahead of earnings for sure. But second point is, I think these stocks, free floats have already been gobbled out, and I think the free float available for people to grab is very low. That's why every unit of rupee invested in these stocks is resulting in a re-rating. Unless this liquidity cycle gets broken, I think this whole fundamental being looked at is going to be a far-fetched thing. So we are tracking the liquidity in these sectors very closely. Like if you look at the SBI Infrastructure Fund, which is the largest AMC's infrastructure fund, I look at its inflows every day. Unless this inflow, like yesterday, there was about 100 crore inflow, 75, 80 crore inflow, if I'm not wrong. So what is going to happen is, unless this cycle of liquidity breaks, fundamentals will not be looked at. So the focus will shift as soon as this starts taking a breather. So we at Anand Rathi, we've been very clear, be the broader market or be these hot sectors, we would be the first ones to pass the pillow as soon as the tide of liquidity turns, and then the fundamentals take the primary seat in terms of the valuations. I think till that happens, I think I would be ignoring valuations for some more time, maybe a couple of months or 6 months, or even as latest as 1 week later, if the liquidity dries up, reality will sink in.
What is the advice to medium and long term investors? Should they consider tweaking their portfolio as you go into this budget? Or do you feel like while it may induce a little bit of volatility, the long term vision and portfolio should remain the same?
I think there are three pieces of advice for a long-term and a medium-term investor. Medium-term, by which I mean 3 year plus. Long-term, by which I imply 5 to 6 years. The first one is your equity exposures can still be higher. If you don't have for your 5 years money is greater than 70-75% in equity, I think there is still a very important increase in allocation needed. So I would not recommend anybody to be less than 70-75% for 5 years monies into equity. Making money in debt is not going to be so easy. Even if interest rates were to come down, the long end of the yield curve will not make you too much money because it's not gone up. That's point one. Point two, if you have been in the broader market, which is mid cap and small cap, it is time to take some money off the table. Quite a few people have been negative from last October in terms of valuation, but I think liquidity has brought them here. I think taking some money off the table and still the broader markets will do well. But if your allocations in small caps have exceeded more than 25%, you would have to bring it back below 25% and about 20-25% in mid cap and 50-55% in large cap. I think that's the second piece of recommendation. Third, please don't put your money, long-term monies, into thematic schemes. Because the themes are very popular and diversified funds are also exposing themselves to several sectors which are actually being independently launched as sector funds. I see several retail investors buying sector funds. I think that's something which is avoidable at these current valuation levels. Looking at three derivative indicators, I would say the market is now grasping for breath. And that kind of rally on 4th June, of course, I was very positive, unlike most. But I think now the FII long positions have exceeded 84%, which is a great sign of a reversal or at least a breather. So don't get too carried away with the rally which we have seen this expiry from 4th June, the last expiry from 4th June.